Hello and welcome back to another video. In this video I will present what the PDT rule is and how you can avoid it. You have probably heard about a rule prohibiting traders to day trade more than 3 times in a given period. It can be very annoying to not be able to capitalize on a great setup because you already used your 3 day trades on something else. Besides missing great setups, the PDT rule can actually be dangerous, because if you already used your 3 trades, you can actually be stuck in a position without being able to exit it, because you already performed 3 day trades in the past days. Therefore, I want to present to you what exactly the PDT or pattern day trader rule is and how you can avoid it so that you can day trade as often as you want to. But before we get into how to avoid the PDT rule, I will present what a pattern day trader or a PDT even is. You can only be classified as a pattern day trader if you do all of the following things. The first thing is you have to have a margin account. If you have a cash account, the pattern day trader rule does not apply to you, but more on that a little bit later in this video. Besides having a margin account, you also need to day trade at least 4 times within 5 business days. So if you day trade at least 4 times within 5 business days in a margin account, you will be flagged as a pattern day trader. Getting flagged as a pattern day trader isn't necessarily something bad. The bad thing is people that got flagged as a PDT have to have at least $25,000 in their account. So if you want to day trade more than 3 times within 5 business days in a margin account, you will need to have at least $25,000 in your account. But if you have less than $25,000, you will only be able to trade 3 times within 5 business days. So everyone with a smaller account is restricted to 3 day trades per 5 business days. Before I get into how you actually can avoid this rule, I just want to present what exactly a day trade even is. It is very important to understand this definition of a day trade. A day trade is the act of opening and closing trades in one day. So it does not matter if you buy a security and sell it later in the day, or if you sell a security and buy it back later. The PDT rule does apply to buying and short selling. Averaging in and out of trades, which is opening and closing partial positions, does not count as multiple trades. So if you open a 1,000 share position in 3 steps, that does not count as 1 or 3 day trades. The same goes for closing. If you close a position with 3 orders or more, it still won't count as a day trade. But be aware that this is only the case if the opening trade wasn't on the same day as the closing trade. If you open a trade and close it with 3 separate orders the same day, it will count as 3 day trades. So if you're day trading, I don't recommend scaling out of trades, because every separate closing order will count as another day trade. There's one last thing that I want to touch before we get into how you can avoid the PDT rule. That thing is, why does the PDT rule even exist? Financial regulators like FINRA initially created this rule. They created the rule to protect investors from greater risks. Financial regulators like FINRA think that day trading is more risky than investing or other forms of longer-term trading. Therefore, they want to protect investors with smaller accounts from the greater risks of day trading. Furthermore, the PDT rule actually fights over trading, which is a huge mistake, especially amongst newcomers to the stock market. However, many people aren't satisfied with the PDT rule, and therefore a lot of people try to avoid it. So let's get into some different methods to avoid the PDT rule. Well, the first and most obvious way to avoid the PDT rule is depositing more than $25,000 to your broker account. But as you're watching this probably isn't an option for you. The second way to avoid the PDT rule is using cash accounts. The PDT rule only applies to margin accounts. So if you have a cash account, the PDT rule won't apply to you. However, cash accounts have some other limitations. For instance, you have a reduced buying power in cash accounts. In addition to that, you can't short sell or trade naked positions like short calls or short puts in cash accounts. And besides that, the cash that you trade with takes time to settle, so you can't immediately use the cash that you traded with yesterday the next day. The cash settlement time depends on the asset class that you trade in. The third method to avoid the PDT rule is changing broker. There are some brokers out there that don't follow the PDT rule. So if you set up an account with those brokers, you can day trade as often as you want to. One example of a broker that does not follow the PDT rule is SureTrader. But note, if a broker does not follow the PDT rule, they aren't regulated by financial regulators like FINRA. So if that's the case, they will probably be regulated by some sketchy regulator that's based in Bahamas or Cyprus or another country like that. Regulations from these countries aren't near as trustworthy as regulations from trustworthy regulators like FINRA or the SEC. Another way to avoid the PDT rule is opening more than one broker account. You will have 3 day trades per broker account that you have. So if you have 2 broker accounts, that's already 6 day trades instead of only 3 day trades. So the more broker accounts you open, the more day trades you will have. Still, I wouldn't necessarily recommend opening 10 different broker accounts. You probably shouldn't open more than 3 separate broker accounts. The fifth way to avoid the PDT rule is trading other assets. The PDT rule does not apply to all assets. It applies to stocks and also to options trading. But if you trade other assets like forex or futures, the PDT rule won't apply. The sixth way is one of my favorite ones, and that's holding overnight. If you enter a position just before the market close and exit it right after the market open the next day, it won't be considered a day trade because you didn't close and open the position on the same day. So even though you only held the position for a very short time, your day trade counter won't go up. But this will of course require some adjustments to your trading style. The final way to avoid the PDT rule is quite similar to the sixth way, and it's swing trading. So instead of holding for a few minutes, you could also try to hold for a few days to weeks. But once again, this will require some adjusting to your trading strategy. But if you're just starting out, you could also just learn how to swing trade instead of learning how to day trade. Swing trading can be just as profitable as day trading. Now let us move on to the conclusion. As you probably know, there are mixed opinions about the PDT rule. Some hate it and some like it. The PDT rule actually can have some benefits, but obviously it has some disadvantages as well. On the one side, it can prevent overtrading, which, like I said earlier, is a huge mistake amongst newcomers. However, other times it actually can be harmful. For instance, if you're stuck in a position and can't cut losses because of the PDT rule, that's not a good situation to be in. Therefore, it's so important to always keep track of your day trades. It can be very annoying to disastrous to be stuck in a position. Some broker platforms have a day trade counter for this. And never enter a trade if you don't have the possibility to get out because of the PDT rule. Anything can happen in any trade, and if you're not able to exit the trade and cut losses, that's just disastrous. So if you already made 3 day trades in the last 5 days, don't enter the next trade, just wait. But frankly, if you have under $25,000 in your account, you aren't crazy experienced yet, and that's totally fine, but these regulations do only exist to protect you. Always remember that. There are some ways to avoid the PDT rule, but all of these ways have some disadvantages as well. In my opinion, 3 day trades is good enough in the beginning. It allows you to focus on the best setups only, which is a very important lesson that most newcomers still have to learn. Furthermore, it prevents people from overtrading. One huge problem amongst beginning traders is the lack of education and experience. Education in trading is key to success. Sadly, most new traders skip this very essential part of education. And that's also why rules like the PDT rule exist. They only exist to protect these people from harming themselves. Also remember, you don't have to day trade all the time. You could also trade in other time frames. For instance, you could hold positions for a few days by swing trading. But no matter what you do, remember to educate yourself and know what you're doing before you risk your hard-earned money. Thank you so much for watching. I truly hope you enjoyed this video. Let me know in the comment section below what you think about the PDT rule. Do you hate it, or do you think it's actually not as bad as most people say? As always, if you enjoyed this video, make sure to like and subscribe. Once again, thanks for watching.